Now, Federal Reserve Chair Jerome Powell used a cautious tone as he testified before Congress, addressing growing concerns about inflation, interest rates and the effect of tariffs on the U.S. economy. Powell appeared before the House Financial Services Committee on Tuesday with this message: the Fed is watching, waiting and not rushing into rate cuts just yet.
What will actually happen with rates is going to depend on the path of the economy, and that's highly uncertain. So I would just say what that means at this moment in time is that a significant majority of the committee, but also there's a pretty significant minority that doesn't agree, but a significant majority feels it will be appropriate to reduce rates later this year.
Right now, the Fed's benchmark interest rate sits between 5.25 and 5.5%, the highest it's been in over 2 decades. But Powell hinted that if inflation cools for the job market or the job market weakens, rate cuts could come later this year. So essentially, what does this mean for an average American citizen? Credit card interest rates remain high, which means borrowing is still expensive. Mortgage and car loans are also holding steady at elevated levels. There's no relief yet on that front. And with tariffs possibly taking effect this summer, we could see grocery and everyday prices go up further. In short, while the Fed waits for more clarity, consumers may continue to feel the pinch from higher costs.
The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity.
Powell pointed to new tariffs as a key risk, while details are still emerging, analysts say these could raise consumer prices by 0.2% to 0.4% this summer, and that depends on how widespread they are. Right now, inflation is hovering around $3.3, still above the Fed's 2% target. And while unemployment remains low at 4%, some signs point to a slowdown in hiring. The Fed is balancing these two forces carefully, waiting for clearer signs before changing course.
We're committed to returning inflation sustainably to 2% and keeping it there in the long run. And what we're doing now is we had cut rates by 100 basis points, so they've come down quite a bit. And when the time is right, I expect that will continue, and that will depend on economic factors in the coming months for starters.